Today we are covering the silent partner every trader has. Whether you already know about it or not, he will be coming to collect his cut. I am not a financial advisor. This video is for entertainment purposes while I do my best when researching. Do your due diligence before investing. We traders don't need to report to the IRS stocks we buy, and we don't pay taxes on stock transactions we make. But we need to keep documentation of transactions to help determine cost basis of stocks when we decide to sell them. Generally, we have to pay capital gain taxes on stocks we sell if the value of the stock went up since we own them. Capital gain tax on a stock we sell and own for more than a year is generally lower than ordinary income tax. If you've had the stock for less than a year at the point you sold it, you simply pay your ordinary tax rate. Not paying taxes on stocks can lead to prosecution for tax evasion, including a penalty of up to $250,000 and up to 5 years in prison. If you see value on this video, or if you do not, please drop a like or Hulk pulverize that button. Subscribe and hit the bell, that way you get the next video. I will go over the latest news I found on this, and then I'll cover a few other thoughts. On Yahoo Finances, the headline goes, every investor has a silent partner when trading stocks. As I wrote down, we've been in a whiplash of a bull market, seeing the S&P 500 go from 2,400 to 3,400 in a matter of months as tech stocks push the market up and up and up. A lot of people have gotten into day trading, and retail investors have largely been the big winners of the rally, at least the first chunk of it. The market has welcomed a lot of new investors since the pandemic hit the US, and they are trading a lot. According to a recent Yahoo Finance Harris poll, 44% of investors try to time the market, and people who are trading frequently are making around 4 trades per month on average, which really does add up and can create hefty taxable gains for the lucky ones. Barry Ritholtz, chairman and CIO of Ritholtz Wealth Management and a consistent voice of a reason in the financial media, who wrote a piece recently about market timing and profit that gets to the heart of a potential problem for investors who shuffle their stocks frequently. The fact that every trade made has a silent partner, Uncle Sam. Whether you should time the market is debatable. Ritholtz and most experts advise against it, but a lot of people, especially rich ones, do it frequently. But the main problem, Ritholtz writes, is that doing so often means you hold a security less than a year, which means you have to pay taxes as if the gains were ordinary income and not long-term capital gains, which enjoy lower tax rates. Short-term capital gains come from selling assets for a year or less and are taxed at your ordinary income tax. Long-term capital gains are gains on investments you owned for more than a year. They are subject to a 0%, 15%, or 20% tax rate depending on your level of taxable income. Uncle Sam is involved with all your trading wins, Ritholtz says, and he's definitely more than a junior silent partner. States also usually have their own taxes as well, making short-term trading even less profitable. A key problem for the new batch of day traders powered by trades that cost $0 is that a lot of people might not be aware that they will be on the hook for a big chunk of money come tax time, or earlier if they have to pay estimated taxes. They may not realize they have a partner, Ritholtz told Yahoo Finance. Tax gains are two very interrelated things, but they seem independent to someone making frequent trades months before there's any hint of tax season in the air. Brokers like Robinhood, Fidelity, Vanguard, Schwab, and others have resources on their websites for investors to learn about cost basis, capital gains, tax brackets, and other related topics. But anyone who realizes gains has to be proactive to learn about their tax responsibilities that might change how an investment strategy works. The other thing interesting I found on the usatoday.com news, many Robinhood users will own higher taxes than other investors, and here's why. We roll down, as most people with even a passing interest in investing know by now, Robinhood is an online brokerage firm catering to young and novice investors. Its flashy app claims to make trading easier and more accessible, but it also allegedly incorporates behavioral nudges that push users to do more short-term trading. Because of the app's incentives and its customers' general lack of experience, Robinhood users tend to be very active traders. In fact, the brokerage saw more daily average revenue trades in June than all major incumbent brokers, and more than the combined number of Dart on E-Trade and Charles Schwab. Unfortunately, such frequent trading has a number of downsides, including the potential to be taxed at a higher rate than investors who don't trade as much. Why Robinhood trader may end up overtaxed. To understand why Robinhood investors may lose more of their profits to the IRS, you need to know how you're taxed on profitable investments when they are in a taxable brokerage account as opposed to a tax-deferred one. You're taxed in the year you sell. Specifically, you pay capital gains taxes at one of two different rates: short-term capital gains, gains on assets owned for 1 year or less, are taxed at ordinary income tax rates, but gains on investments owned for a year or more are taxed at a lower long-term capital gains rate. How much lower? For single tax filers with incomes up to $40,000 and married joint filers with incomes up to $80,000, the long-term capital gains rate is 0%. It's 15% for single filers with incomes up to $441,500 or married joint filers with incomes as high as $496,000, and it's just 20% for high earners above these thresholds. Lower tax rates apply to long-term gains because lawmakers want to incentivize responsible long-term investing. The problem is Robinhood may subtly encourage inexperienced investors to engage in exactly the type of short-term speculative trading these tax incentives are designed to discourage. Short-term trading typically won't be consistently profitable over time, but in recent months, Robinhood users have been riding the wave of the coronavirus rally, and Robinhood's high trading volume suggests many are pocketing gains and selling shares of stock they're very unlikely to have held for a year or longer. Those who sell and own taxes at higher short-term capital gains tax rates keep a smaller percentage of their profits. That may not seem like a big deal since, after all, profits is profit. But since speculative trading isn't likely to pay off over the long haul, it means less of a cushion to absorb future losses. Of course, you can offset capital gains with capital losses, but that only helps if you either experience the losses in the same year as the gains or had them in prior years and carry them over. And while experienced investors often engage in tax loss harvesting and make strategic choices on when to sell losing assets to offset gains, this may not be a common technique embraced by novice short-term investors of the type Robinhood attracts. At other brokers that don't cater to inexperienced traders or provide behavioral nudges to encourage active trading and that appear to see far fewer trades because of it, investors may be more likely to hold their stocks long enough to be taxed at lower rates. Most of these other brokers also offer tax advantage accounts Robinhood doesn't, enabling investors to make pre-tax contributions or tax-free withdrawals and defer taxes or gains, which Robinhood investors can't do. Of course, if you are a Robinhood investor who made a profit, you may not care that you pay taxes at a higher rate than long-term investors, but realize that you are both taking a bigger risk by investing for the short term and giving up the favorable tax rate. That's a big advantage of earning investment income. By contrast, long-term investing maximizes your chances of profitability over the long term and means you'll keep more of those profits rather than owning a big bill to the IRS. Any thoughts, comments, questions and ideas? Drop them on the comment section down below. Short-term capital gains are taxed as they are ordinary income. Any income received from investments held for less than a year must be included on taxable income for that year. Short-term capital gains or loss regards stocks held for less than 12 months. In contrast to long-term capital gains that requires holding a stock for longer than 12 months. The rate a person is taxed varies regarding many factors such as how much that individual makes a year. But long-term capital gains come at a much lower tax rate between 0% and 20%. It requires selling shares to be able to write off a loss. But when owning a worthless stock that the company goes completely out of business, and once there is nothing left for shareholders, you can still deduct that loss as a worthless security still without selling it. If this year a person decides to sell the stocks and cash in the gains, and also has a loss on another stock, that person can write off the loss and pay less on the gains, balancing it out. Any capital asset sale creates a taxable event. We have to report all sales to determine a gain or loss. A super quick recapitulation. We can minimize capital gains taxes by investing for the long term, using tax advantage retirement plans such as a Roth IRA, and offsetting capital gains with capital losses. I hope you were able to find some value on the work I put here today. Thank you so much for watching this video. Feel free to check out some of the other videos coming up on the next screen. Have a wonderful day. Capital gains tax on stocks we sell, motherfucker, bro, including a penalty of up to $250. Any income received from investments held for less than a year